KPMG presents The Blueprint, Business in the New Normal.
Focusing on policy and reform framework, the Indian government has pushed for the digitization of various agencies, including the tax department. The government has joined the ranks of countries that have embraced digital technologies to enhance tax authorities' capabilities. With the advent of technology, the Indian Tax Administration can now focus on reviewing transactional tax compliance right down to the transaction level using technologies such as data analytics. Given this, companies need to ensure that voluminous data sets that are used in tax compliance are processed not only more accurately but also in a time-efficient manner. In this panel, we probe the minds of industry experts on why it is imperative to automate the tax function on KPMG Presents The Blueprint, Business in the New Normal in association with CNBC-TV18. And joining me today are two experts. We have Rahul Kashikar, who is the partner and head of tax technology at KPMG India, and also Sandesh Mahagaonkar, who is the partner at tax technology KPMG India. Gentlemen, thank you so much for joining us today and discussing something which is actually the new normal, digitization across the operational functions as well, and this time around tax technologies. So let me begin with you, Mr. Kashikar, and let me begin by asking you, how do you view the government's approach, that is the Indian government's approach towards transforming the tax landscape of the country through digitization, especially after the changes that we've seen during demonetization, then there was GST, and not to forget COVID-19?
Thank you, Sonal. So digitalization of tax collection is an extremely important aspect in the overall growth trajectory of our country. The only effective way to reach and collect taxes from our huge taxpayer base and to potentially expand the base is through digital mediums. While the digital transformation of tax collection did have its initial challenges, it definitely leads to more effective outcomes in the longer run. For example, you can now witness a steady rise in GST collections over a period of time. Digitalization has helped in significantly improving the Indian tax authority's ability to gather more tax information and insights into the transaction level positions of taxpayers. Now, this also alters the level of focus on tax data and information for taxpayers, and that in turn requires taxpayers, especially corporate taxpayers and professional tax firms, to digitally transform its tax systems.
Absolutely, point taken, Mr. Mahagaonkar. In that case, when one is actually implementing these tax automation function, what kind of integration needs to be done with the internal systems as well as the external systems, and how should an organization go about this change?
Both CBDT and CBIC have enabled taxpayers with multiple APIs and upload and download mechanisms on their portals for enterprises to submit or retrieve the data. In addition to preparing its tax filings and internal reporting, tax functions are required to collect and assemble data from multiple source systems such as your ERPs, accounting systems, and vendor management systems. Instead of tax team members downloading data from their ERPs and from government portals or GSTN portals, technology can help seamlessly connect all these three wings. Basically, government has enabled multiple APIs, as I said earlier. So, for example, most of the companies are generating e-invoices by integrating their ERPs with e-invoicing systems that in turn connect to the GST and through APIs. Another example would be for performing reconciliation between vendor-reported GST and purchases vis-a-vis the purchase register that we can download from ERP. In this case, it is possible to automatically download input tax credit register from GSTN using the APIs that are published by the GSTN. So overall, integration methods to be used varies depending on the organization, business, and the data volume needs. I would suggest that organizations should evaluate such integration for each tax process that involves data exchange between multiple systems.
So, Mr. Kashikar, we are in a state of rapid globalization, growing regulatory and business complexities as well, evolution of tax technology. How should the finance department look beyond the traditional functions of operating models and actually plan to transform the tax function in order to provide greater value to the organization?
Traditional tax functions of enterprises in India have been manual in terms of governance and data preparation for tax compliances. In most cases, only the last mile tax filing is technology driven. That too because of the government's push for e-filing. However, there is significant scope for transformation of tax functions using technology and automation. Now, there are three primary areas for transforming beyond the GST filing, which is currently being done. The first one is digital tax governance, where all your data and documents for tax are digitized and accessible on a platform. As a tax or a finance leader, you should be able to track all your tax compliances and litigations using such a platform. Digital tax governance is also gaining importance amongst enterprises because even tax authorities are turning to faceless and digital audits, which means data and documents needs to be stored systematically and available at any point of time for such digital assessments. The second one is automating data preparation for tax compliances. There is significant opportunity to automate various manual processes which are undertaken in the tax function. For example, listed companies need to validate data and tax rates for deducting taxes on dividends paid to millions of shareholders. They also need to prepare and upload thousands of forms on government portals, and all these activities need to be done within a matter of few days. Now, it is humanly impossible to manually validate millions of line items in a few days, but using technology can vastly improve the quality and efficiency of such processes. Now, the third aspect of transformation is to gather tax insights from large volumes of data. And with GST data available, tax functions and organizations can generate actionable insights. Let's look, for example, location-wise GST input tax credits can now be analyzed for optimal utilization. Another example could be identifying top suppliers who are non-compliant or delayed with their GST filings. With the help of tax analytics, the business teams will be able to take informed decisions and actions, which can then, in most cases, help even increase the working capital.
So, Mr. Magankar, while we are talking about a lot of benefits of tax automation as well, right? How does it improve data accuracy and help identify tax risks and potential tax leakages? Can you share some of the examples here as well?
There are numerous opportunities to enable tax processes with technology to improve accuracy, which eventually leads to reduced compliance and litigation risk, and also to improve upon the working capital and tax leakages. There are some very interesting tax automations which companies are implementing today in India. Number one, I would like to talk about the automatic blocking of the vendor payments. So basically automatically blocking the payments to the GST non-compliant vendors and releasing those payments subsequently only when they reflect on company's input tax credit segment. This automation, if set up within the company's ERP, can help avoid disallowances of credits taken and would also result in increased working capital. The second example I would like to give is another, again, related to GST. The GST automation, again, it is within ERP to automatically monitor the input GST tax credit taken and reversing them timely within 180 days if company does not report those sales in its GST returns. This automation can help minimize the penal risk. The third example could be configuring your ERPs right for specifically for tax processes. This can significantly improve data accuracy and efficiency of subsequent tax compliant processes. For example, appropriately configuring and customizing ERPs for TDS and GST purposes can improve the overall accuracy and ability to support transactional level audits. Lastly, even your TDS credits can be optimized using technology-enabled processes.
Very helpful examples. So that takes me to the next question, Mr. Kashikar, because we are talking about tax authorities increasingly embracing the value of digital as they look for more real-time reporting in the tax function, right? So how do you see the increase of automation specifically in the tax function, something that we've been discussing?
So the focus of tax authorities not only in India but also globally is on the underlying data used for tax compliances. For example, whether the data reconciles between what a seller has reported and what the buyer has reported, whether the data shows any trend over the previous years or months which requires further investigation, whether GST's return sales data reconciles with what is available with income tax authorities. Now, all this is possible because the data is available with the tax authorities through real time reporting and through digital tax filings. With technology, it is easily possible to compare millions of line items of data not only across different tax filings but also across different taxpayers. So while Indian tax authorities have invested millions of dollars to deal with taxpayers' compliance data, it is equally important for enterprises to have complete control on their data and ensure its accuracy and completeness. This is where tax automation comes into play. An additional reason to increase tax automation in the tax function is the efficiency it adds. Enterprising having millions of line items of data are still largely dependent on manual efforts to process data for tax compliance purposes. This will need to change quickly. For example, in the upcoming GST audits, the tax authorities will be able to reconcile data using technology. In fact, data from GST sales return filings is already being made available by income tax authorities in Form 26As. Question is whether enterprises are proactively creating such reconciliations using technology and without waiting for tax authorities to send notices. While enterprises are embracing automation slowly, as we move ahead, there will be no choice but to bring in automation to manage large volumes of tax data.
You know, Mr. Magankar, we are talking about the fact that you have actually implemented tax automation in the US in some of the organizations before you came to India to KPMG as well. What is the difference that you've seen in the environment and the adoption of tax technology in India?
In India, it is slightly different. The technology and automation implementation in the tax space is primarily for ensuring accuracy and building overall efficiency. It may not necessarily result into cost savings. Typically, corporates in the US are ahead in terms of technology adoption in the tax space. The tax automation in other areas beyond GST filing is still to be broad-based within India. As we speak, however, Indian corporates have started adopting technology and are exploring ways to automate various tax processes.
Well, of course, there are differences in terms of technology, but a typical tax function of an organization spends a significant portion of amount that is on data extraction, collation, analysis, reconciliation, validation, etc. Then this is followed by creating and maintaining records. There are dashboards. How can tax automation go a step further? This is to add analytics as an offering for better tax planning. Mr. Magankar, this is to you because we are talking about being more tax compliant, making strategic decisions. How can tax automation help here?
All of us have heard the saying that data is the new oil. The data is valuable, but like the unrefined oil, it is not much of use. In order to generate value, data must be broken down and analyzed. Data warehousing, data lakes, data ingestion, and data blending are some of the technologies used to assemble and prepare tax data so that the insightful analytics can be generated for tax and finance functions. With significant data that tax function accumulates, it can generate insightful analytics such as analytics around open litigations with possibility of favorable versus non-favorable outcomes. These analytics can help planning for contingent liabilities and provision. The second example could be of compliance tracking analytics. These analytics can provide tax heads and CFOs with overview of all required compliances in each of the jurisdiction, and it can further highlight delays and non-compliances that can result in penalties. The third example would be with help of analytics, global companies can monitor their ETRs across all jurisdictions year over year and to get insights for tax planning and for adjusting intercompany transfer prices based on the insight data provided by these moving ETRs. So lastly, using GST compliance data, numerous insightful analytics can be developed for analyzing sales trends, profitability, and distribution network optimization. For example, e-way bill data and sales register can point to sub-optimized distribution route. In summary, once organization get control over their tax data, the data will enable us to generate various insights that are not limited to tax but can help other business functions as well.
So, Mr. Kashikar, we are talking about investing in technology here, right? So, what are the key benefits for an organization that they can derive by investing in tax automation, and how can they go about quantifying those return on the tax investments or the technology investments that we are talking about?
This point about return on technology investment in tax is very important to understand. The traditional method to quantify return on investment in technology may not strictly apply to tax. It is like this. It is very economical, say, for a husband and wife to travel by a two-wheeler. But when the family size increases, it is safer to travel by a four-wheeler, which may be more expensive. That's how it is in tax. With medium and large enterprises, we need to evaluate the risks of not automating, which could lead to non-compliance and non-availability of data when required, as opposed to only quantifying the financial return on investment. Some of the risks of manually handling large volumes of data could be non-quantifiable upfront. For example, loss on working capital, penalties for inaccuracy in filings, reputation risk, and so on. I would personally recommend that when enterprises begin their journey on finance automation, they should give importance to tax automation equally. Even though it may not have easily quantifiable returns in the short run, but definitely will make an impact on the tax function and make it more robust and data driven.
So, last question to you, Mr. Kashikar, before we let you go on this one. What are the key trends that transform or could transform tomorrow's tax world? And what would be your three-piece advice to corporations that they should be prepared for in this case?
The good part is that bringing in tax automation does not need one large transformation project. It can be easily implemented in smaller bites, automating one or two processes at a time. So how should one go about doing this? Number one, be ready to respond to data-driven audits for which enterprises will need to take control of their data. Number two, use advanced data analytics and provide value-added insights and trends to the business, which can add to the bottom line or even cash flows. Three, optimize the use of your ERP systems and source systems to capture tax-relevant data adequately and accurately to minimize manual efforts. And lastly, automate repetitive tasks which can be undertaken autonomously by technology. So if I have to summarize, embedding technology in the tax function is helping enterprises to minimize the risks and inefficiencies arising from manual activities. It will also provide tax functions more time to focus on partnering with business teams for value-added activities. It will create more time for tax functions to focus on areas such as managing litigation, improving cash flows from tax, and so on.
Gentlemen, it was a pleasure speaking with you. Thank you so much for joining us today and explaining to us everything that's happening in the tax world when it comes to automation, the benefits, and the outlook for this as well. Thank you so much.
KPMG presents The Blueprint, Business in the New Normal.